This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Oh, good day, everyone. How you going? Phil Tarrant. Welcome to the Smart Property Investment Show. You may have heard we cracked 1,000 episodes of this show in May, which is pretty big. It just reminds me how many conversations I've had with property investors and people from within the property space over many years. So maybe I'm getting old, but 1,000 episodes is a lot. That's a lot of conversation, a lot of people. And people always ask me how I learn about property and how do you become a property expert? Well, I always say, first point, I'm not a property expert. I'm a journalist who talks a lot about property, but I've learned a lot along the way, which I've been able to deploy that myself, but also be a conduit of information to help other people educate themselves around property and property investment and how they can best create wealth through it. Recording on budget day, favorite time of the year for finance journalists. So we're sitting around, we've got the pizzas ordered, ready to go for later on this evening as we pick through the budget and find those stories. So watch this space. We'll come out with our views and our musings around the budget and what it all means. Obviously, cost of living pressures will be a key focus of it, trying to ameliorate some of the challenges Australians are facing without compromising or accelerating inflation. So it's a tough budget to hand down, a big focus on housing, and that's where we'll pull it apart moving forward. But after doing this podcast for so many years, what I've worked out pretty quickly is that property investing is as much a game of finance as it is investing specifically in property. Fortunately, we bring our friends over at Finni Mortgages onto the show on a regular basis to tell us what's going on in finance so we can keep our finger on the pulse and understand what's happening and how you can ensure you're making the best decisions when it comes to investing in property. Eva Loisance joins me. Head of broker over there. How you going? You well?
Yeah, good. Thank you. I've had a few weeks off, so that's good to connect again. Rested,
recharged, ready to go?
Ready to go.
Ready to go. I hear you got a new broker, Eva. What's going on there? Part of the Finni team.
Yeah, so, more and more investors coming our way. So we got somebody who is himself an investor, has been in the business for over 10 years, and is going to bring some new ideas and ways to do things.
What's the recruitment process like for Finni Mortgages? I imagine there's a lot of brokers apply to join. What do you actually look for? Like, what is a must-have and what is a non-negotiable if you want to be a mortgage broker for Finni Mortgages?
I think investing needs to be their way of life. You sort of think of it all day, every day. So I wouldn't even consider somebody that knows finance without investing themselves. So it's more about, I guess, the person and how they think than their work experience in some ways.
So my absolute mindset, they've got to understand investing in order to be a good mortgage broker for investors.
And believe in it and do it. Otherwise, I don't think you can work into something you don't love and believe in.
So what's the new broker's name?
Robert.
Is Robert more of a property investor than a mortgage broker, or is a mortgage broker who also likes property investing?
I think people start investing, realize they need to know a lot more about finance because it's all about finance, and I guess want to learn more, become a mortgage broker.
Fair enough. Same thing happens in buyer's agent space.
That's right.
People start investing in property, they go, hang on a second, I don't really like my day job. I'd rather be a property investor, so I'll move into profession. It's a booming sector, buyer's agency, growing rapidly. I still don't know the numbers. I'm trying to work it out. It's a bit of a black hole in terms of how many properties actually transacted through a buyer's agent, but there's a new cohort, cadre of buyer's agents coming through. And, my job means I get to meet all of them, which is pretty cool. One of them buyer's agency of the year, InvestorKit, Arjun Paliwal, who, from what I understand, Eva, you guys do a lot of work with him. What's the tie-up?
Yeah, I think we do get a lot of investors that understand that they need a buyer's agent to do well and scale up, the same way that they know finance is key to keep going. And as you said, actually, we have a client, Arjun Kit, that I think joined your team as a buyer's agent.
Well, yeah, it's crazy. Yeah. So I've invited Arjun into the show. Last time I caught up with Arjun was in a podcast studio, and we were talking through all the reasons why, for the second year of the row, he secured the Buyer's Agency of the Year at the REB Awards. So we've done that to death. Everyone knows it now, Arjun.
Well, first thing is, it's great to be on together, and we're hoping everyone knows it. We're stoked about it, but at the same time, look, I'm very grateful for that win. And I think what comes from that win is not just the award itself, but the many clients' portfolios we've helped scale, which definitely an exciting theme for today's chat as well.
Yeah, I want to chat about scaling your portfolio because most property investors want to do that, particularly those that listen to podcasts. Some property investors just get told to buy a property by their accountant for the purpose of negative gearing, and they typically aren't focused on scaling their portfolio. But most of the people that we connect and engage with, all three of us, would be those who are looking as property investment as an accelerator for creating wealth, and therefore scaling your portfolio is key, which you only can scale your portfolio in line with your ability to secure finance. So there's a lot of connectivity. So InvestorKit and Finni sort of share a lot of clients, like the ecosystem just pulls you guys together.
Yeah, we do. I think like as a result of like what you touched on before, Eva, the whole idea that Finni's built for property investors, it means we end up sharing a lot of clients because we have property investor clients, as does Finni, and they're both in that similar mindset, which is they want the right finance team around them to make sure that they can have people who are investor focused, aren't just here doing maybe a home to live in as 3/4 of their mortgages. And that's actually really important because if you do something as a behavior all the time, even if you may carry the knowledge or the skill set to help, muscle memory kicks in. Your mind doesn't work in the same way. Your thinking of the policies don't work in the same way. Your holistical thinking of that person's portfolio in the same way. And it's the same, not just from finance, but buying. When we have, the 99-to-1 ratio of one person say, I'd like to help with the home. And then, we'd say, hey, kindly decline because that's not our forte. And then the 99 people that we deal with out of that 100 are just all investing focused. That clearly shows where our muscle memory, our thinking, our strategic approach, our savvy ways to position someone's portfolio. So to know for clients that you get that from both a buying perspective and the finance perspective, Phil, is really that X factor that we end up bringing together on many client situations.
So the question I have for you, Arjun, what typically stops property investors, and we'll chat about it today, but what typically stops property investors from scaling their portfolio?
Yeah, look, I'll start off with a couple of points. The first point that comes to mind is their belief that the valuation that they have in front of them is the only valuation. And this is really interesting, right? This is one of the core things I've learned when I realized I had multiple valuers all go out and differently have an opinion on a particular property. I even then tested this within my own team. We have, many associates in the team of buying who end up actually valuing properties for a living, and they value hundreds of properties in a week. And so imagine that they all do this, and I gave them all one address and say, hey, let me know what you think this is, how you got there and why. And guess what? They all came up with different figures, not hugely off, but different figures. And so this is the key thing. If you're going to be working with a singular bank or a broker that has their comfortable few banks that they always work with, the dangers are you're going to be looking at the value of the property and you might have a bit of conservatism added to it. And if that ends up happening, Phil, all of a sudden, what you think is the equity you have isn't really what you have more. And if you have more sitting in there, suddenly you're in a position to start going from one to the next as that first part with equity.
So I apologize to our listeners that might go, yeah, I know all this, but it's good to get back to the basics to remind just the basic economics of property investing. The question I have around that, Arjun, is why does it matter? Why does a bank valuation matter? Why does the equity position matter for the purpose of scaling your portfolio?
Yeah, so what ends up happening is that people grow from 1 to 2 to 3 properties, as an example, using a combination of their deposit, which is the cash that they've saved from regular savings and or lump sum amounts that come through bonuses, commissions. And secondly, they use equity. And a simple example of equity could be a $500,000 home that has a $350,000 mortgage. And so if you were to take that to 80% of that $500,000 loan, there'd be $50,000 equity sitting there. And so when people use this equity, they're essentially borrowing against it and they're increasing the loan in their property. But if they're using it for investment purposes and their accountant feels it's done correctly, that investment interest that they have is tax deductible. And they're using that to fast track what they might ordinarily take 1 or 2 or more years to save to be a deposit on their next home. And so by doing that across multiple banks, we just had a case recently where a property we purchased for someone in Bundaberg just over a year ago, suddenly one bank had that at about 9 to 10% in terms of increase in equity. And then other banks had that at close to 12% increase in equity. And so if you're looking at them, you can either be conservative and go somewhere you feel like you don't need to take up as much debt to see that increase, or you might go, hey, no, this one seems more closer to my estimate. The bank's closer to that, and I want to go to them, which is a mutual client that Eva and I are speaking about, and they're now looking at taking out equity to actually purchase their second investment as a result of the growth they've seen.
So, Eva, is that a consideration for people if they sit there and get two bank valuations with different lenders? They might pay a premium in interest rates, but that bank might value the property differently. So therefore, they can access.
We often get 2 to 3 valuations, and we know there are banks and lenders that are a lot more generous with their valuations than others. So we do consider that when somebody wants to go again, ASAP. So we go with the valuation that's the highest, even though the rates might be a bit higher with that lender. But in the grand scheme of things, and when you look at the bigger picture, sometimes it's better to go now on a higher interest rate than waiting 6 months or 12 months until you can save up that money, and you do much better. And yeah, the difference can be huge, like typically 10 to 15%, sometimes more between banks and valuations. So
that's a key point. And this is one of the greatest enablers in property investment is time, right? That if you're making the right investment decisions, you want to be holding properties for longer. So you may need to pay a small premium on the interest rate to extract more equity, but I'm sure you can do the sums and work out what the long-term upside of that is, stalling your purchasing by 9 months, 6 months, 12 months, whatever the number is. And by the way, none of this constitutes financial advice at all. Apologies for the disclaimer. We're just talking about some very generic scenarios around it. But Arjun, you made the point around extracting equity from a property. That comes at a cost. So if you are increasing the debt position in order to extract funds out of it to deploy elsewhere, that means your loan will be higher on that property that you're extracting it out, and therefore the cash flow position on that will be different. I know a lot of people kick off investing in property by pulling that money, that equity out of their principal place of residence, which might be a nice place to start. But you need to remember that your principal place, if you increase the debt on your principal place of residence, there's no tax consequence for you by doing that. So I would imagine, Arjun, once people start investing in property, they'll refinance investment properties rather than their principal place of residence as an accelerator for scaling their portfolio. Because if you increase the debt on the investment property, you still can offset that against your tax against that property, correct?
Look, a little bit of both. We see people use investment properties as one source, but many people also want to turn as much of their debt on their home to become tax deductible over time. So this is where people do something called debt recycling, where they're essentially going, hey, against my home, I want more of it to be deductible debt because the purpose of the money was to be used for investing. If they're going to go out and buy a boat or a car, it might be a different story, right? And so that's where it might not sit in that category. And this is where the accountant will come in and give them that guidance. But what you've just touched on, Phil, is also not just the debt component, but this whole consideration of this, right? Of just being in that position to actually start looking at equity and looking at multiple bank valuations. Me and Eva have found that work best when people are reviewing their portfolio regularly. This isn't something that just happens in isolation where people just go, oh, 3 months in, I'll go and do a bank valuation out of nowhere. We typically find that 12-month to sort of 15-month is a really good timeline, or 12 to 18-month even, because you get that full first-year cycle to review it. Maybe you need a little bit more time as well because some markets move at different paces. And then you're in a position to start looking at your review with Eva to go, hey, Finni said, I can now borrow X. I can now get valuations across multiple, and I'm able to then use this equity for the next place. Then your buyer's agent, which is when our team comes in, we've done this on multiple occasions. We're looking at it going, great that you've got that amazing outcome. How does that fit your plan for the next? This has now brought your next purchase from 3 years later to this year. And this is where you start having that teamwork together to start reviewing portfolios regularly, which is actually another mistake that I often find people really make in scaling a portfolio. They're not having their finger on the pulse that much. And whilst property is a long-term game, your job is not to be increasing your debt forever. Remember, income comes from having little debt, high income, high values. It doesn't come from constantly having your debt taken into or increased. So the goal for us when Eva and I are looking at it is we want to condense people's journeys to like, hey, we love for you to be a long-term client, but we don't want to be buying for you for longer than 3 to 7 years. Because if we're buying for you for longer than that, Are we just buying for the sake of buying and we just keep lifting up your debts and your equities and we never pull it? Or do we have a goal that we're working towards? And this is where just high regular reviews are a big part of also scaling a portfolio.
And the regular reviews are critical, not only from having appreciation for your capital value and equity position, but also from a cash flow position. That's when you do reviews on rents to make sure your rents are market rents. And this comes to a cash flow point of view, which can be an enabler for people to hold more assets and or start building up. And rather than having to refinance through extracting equity, they can do it through positive cash flow and savings. So this all works in unison. If you're not doing regular portfolios, I highly encourage you to do so. We're going to go to a quick break. When we come back, I want to keep focusing on scaling your portfolio. Back in a moment.
Are you looking to invest for a big return, but are unsure which suburb is up and coming and guaranteed to give you the most bang for your buck? Smart Property Investment and Pure Property Investment have unveiled the Fast 50 report for 2025, identifying the suburbs backed by research that are giving investors the highest returns. Don't make any investing decisions until you read the free report. Visit smartpropertyinvestment.com.au to download the report.
Welcome back. Phil Tarrant from Smart Property Investment with Eva from Finni Mortgages and Arjun from InvestorKit, whose worlds collide at points with a lot of shared clients. Now, Arjun, how often do you see portfolio? We're talking about sort of regular portfolio reviews. How often do you see portfolios coming to you with investors who have been doing this for a little while and you just go, we've got a lot of work to do to change or shape your portfolio, or potentially it's not diversified in a way it should be? Does that happen quite a lot, or do most of the people who come to InvestorKit are largely sort of down the right pathway in terms of their current portfolios?
We get a bit of both. So we have some people where we notice that units seem to be dominating their portfolio, either through the first purchase they made because it was the first affordable place they could get into. And then they turn it into this accidental investment, and then they move into a bigger home or a bigger unit. And then all of a sudden they don't realize that there are a couple of units in their portfolio and it's having pretty stink poor capital growth. And so as a result, we're just noticing that a fair bit, and then we go to fix up mode, and then we start really getting the right track. Another thing is that people start focusing on a hotspot way too much, and they see that the regional Queensland, as an example, was a flavor. So suddenly a portfolio gets built of nothing but a couple of those. They don't understand the importance of a diversified portfolio. And something even I see often with clients together is we want to start to make sure that people have properties in different markets so they can benefit from different points of the cycle. It's all well and true great to be picking up a property every single time with the tea leaves saying markets are great. But then what ends up happening is when they're not great, they could also all be not great at the same time. And then you're twiddling thumbs for a few years. So we want to have a combination of getting good locations. We also want to have a combination of diversifying a portfolio and moving across different states. And a perfect thing I always share with clients is my personal reflection of my own journey. I look back at the last, 9 years of investing, and I think to myself, could there have been better plays in certain assets I picked up? Sure. 5% here or 10% here, a little bit of better growth in either way. But then one thing I do look at, though, that makes me the happiest is how spread it is across 5 states. We've got all of these states doing different things at different times. So I haven't ever had a year where I've looked back at my portfolio and gone, oh, there's no equity to grab. Because just when something else calmed down, something else started to go. And that's something that even I always are looking into for portfolios to go, great, you've got this capacity. Don't just chase the constant hot thing. Let's look at markets that are a bit earlier on. Let's look at markets that might be a buyer's market. They've calmed down a bit. Could you snag a good deal? Be in a different state. And that's another part of scaling that we often see people get wrong.
And even from a borrowing point of view, does it or how does it matter that a diversified portfolio, is that of benefit to lenders, or lenders are happier?
Hugely. So there's really 2 things. One, servicing capacity, and that, a property can help in the way that the rental might be good or not so good. But really, if you've got great property that did well in terms of value and you've got lots of equity, but not enough income to service the debts you would need to keep going, then there's no point. So you really need a good balance of rental yield and rental growth. And sometimes you can also help that by using different vehicles, maybe a family trust and SMSF, and diversify that way as well to keep going. But it's really essential that, you get a bit of everything in there. Otherwise you you will slow down. And that's what I think the big difference between clients we have that have used buyer's agent or not, how many properties and how well the portfolio is going is the difference is huge.
It is important, and lenders like to see, or they want to see your ability to hold on to property without being distressed, and it comes down to your serviceability. So the more money you're making from your property portfolio, the less reliant they are on what your day-to-day income is that you're generating through your energy and effort through work. This comes to the point of if you've got a neutrally geared portfolio or a positively geared portfolio, it's a very different application to borrowing than what it would be if you have largely negatively geared portfolios. And it's a bit tough at the moment. Interest rates are higher than what they were. A lot of people will find themselves, if they were at a neutral position, maybe negative positions right now. It's a moment in time. Who knows what's going to happen with interest rates. But Arjun, how do you go about making decisions with your clients on sort of balancing yield, so income versus sort of long-term capital growth? It would probably imagine depends where they are in the cycle, whether they're still accumulating property or consolidating.
Yeah, so this is something that the Finni team and us, we go through regularly. We see rental yields can be that extra push for someone just to get that one little bit of an extra property. And I think this depends on the stage of an investor's at. I have 3 phases of building portfolios for clients. Foundation properties, they're larger markets, major towns, satellite cities connected to them. And we're not too yield sensitive. Like, we're not focusing on the 5 and 6% yields. We're okay to get a few anchors in there and think of, 3 to 4, 4 to 5% as well. Then we start going to momentum assets. The word momentum describes what's happening in their portfolio. We're getting one to the next to the next. And this is where, when we've chatted with Eva, we've noticed that, hey, if she tells us, guys, I need you to get a 5% rental yield or more on this asset, suddenly we can make that purchase price of $450 to $550 instead of maybe a $400 to $450 with a certain bank. And then there's passive assets. This is where we shoot the lights out on income. We're transitioning to commercial. We're getting high rental yields on residential. And so going through these phases, this is where it depends for each person. If we're in that foundation phase, we're not as yield focused. We're going to look at the best markets that bring that investor a lot of comfort, start their portfolio with markets that have had a little bit less volatility, and we're okay to start chugging along. But then as soon as we get to the portfolios when they start getting stuck and they need that little bit extra rental yield, this is when those 4 to 600s or 5 to 700s in purchase prices suddenly can give you that extra charge, because that rental yield might also be 5 or 6%. At the same time, though, Phil, one thing that we've noticed as well when we do portfolio reviews, it's not just about high yields on purchase, it's about rental growth. If you have rental growth, that can beat markets with lower yields at the start. So if you have a lower yield at the start and say it's 4% and someone else is 5%, that lower yield market could beat that 5% in a few years' time if it grows further. And that's one thing many investors forget about. They just think of the yield at purchase. But then what happens if that market's been pumping up for rents for many years? It doesn't have much in the tank, and it might not come out for many more years of rental growth ahead. Whereas suddenly we see other markets that the price growth hasn't picked up much recently. We're buying in to see what's in the potential. But then we suddenly see rental growth is rising, and we're seeing a lot of trends to show tight vacancy rates that are going to increase these rents. Your yield on purchase changes. Today, your rent might be 400 on a 400K purchase price, but then 3 years later, you could still be at 420 or 430 versus another investor could have 500 per week rents. That'll also shape your scalability in a portfolio, the growth of that, not just the yield today.
So there's lots of moving parts with this, and diversification is key to it. And I want to touch on it a little bit more. We'll just go to another break, everyone. Stay with us back in a moment.
Ready to supercharge your mornings while supporting work which improves the lives of Aussie heroes? This June, Invictus Australia is challenging everyone to rise at 6 a.m. and get active for 6 days by taking part in their 0600 challenge. Conquer your morning however you choose, a run, swim, or a group fitness class, whatever gets you active and connected. Empower others to support your challenge and fundraise to help strengthen the lives of our Aussie heroes through sport, and help Invictus Australia combat the statistic that we lose 6 veterans to suicide a month. So what are you waiting for? Visit www.0600.com.au to sign up today and join the 0600 community.
Welcome back. Phil, Tarrant, Arjun Paliwal and Eva from Finni Mortgages. Now, we talk about Arjun, diversified portfolio in assets, so houses, units, different locations, different regions, the type of asset you might buy at different parts of your cycle from foundation or, to your point, momentum type portfolios. I imagine another key point of diversification is probably a question for Eva, is the lenders that you use in order to finance all these type of things. Doesn't make sense to have all your lending with one lender.
Yeah, look, it can at the beginning. You might have somebody that have their home and their first investment property with one bank or one lender. That's not a big deal. But as you grow, it's very likely you will have to use different type of lenders for different type of reasons. It could be, as we discussed earlier, valuation, or a type of property that is more suitable for one lender. You might be self-employed and we need to do IDOC type of loan, as we call it. So I think the mistake is some people want to always stay with the big four or the big banks and not explore other options, which sometimes are not that more expensive and can really allow you to scale up and get maybe one, sometimes two more properties. So I work a lot with clients on telling them that, going with a bank called, First Mac or Resimac is not a big deal. Their rates are good. They got good customer service, and, that allows for one more property.
I think also, and I'm seeing it's being telegraphed now. I don't know if you've got a view of this, Arjun, but a lot of the banks are crying poor at the moment with their mortgages booked, saying that they're writing mortgages underwater and it's costing more money because of the cost of funds. Now, a lot of people will be sitting there going, well, interest rates are all-time high. How can banks be crying poor around their mortgages booked? But my view is that they're educating and socializing the idea that mortgages are expensive. So therefore, if and when the RBA starts reducing interest rates, they might not pass on those savings to the consumer as quickly as possible, or if at all, citing the cost of funds and the needs to ensure the integrity of their mortgages book. So essentially, in simple terms, when the RBA comes out and says that's dropping the official cash rate by 25 basis points, for example, don't expect the banks to pass that on immediately like they would do rate rises. RBA puts 25 basis points on top of the official cash rate. Guess what? The banks are quick and they'll dedicate all their resources to passing on that increase as quickly as possible. They may not do the same thing the other way down, and I think that's going to be a given. So what I would be doing, Eva, at this moment in time, and depending who you talk to, you don't know when interest rates are going to start coming down. But I think in order to get more competitive interest rates, borrowers will probably need to refinance rather than just expect the banks to pass that on. We'll touch that in a moment. But Arjun, on that basis, then you would be mad not to be diversifying the lenders that you use, because if it's all with one lender and they choose not to pass on interest rate savings, that means you've got all your eggs in one basket, right?
Yeah, this is definitely one important factor. I think you're onto something, Phil, with the banks and what they might be doing there. At the same time, I think that, it's probably a bad business decision on them for how they've not diversified their income streams. Aussie banks, I did a deep study on this as part of one of my thesis for my earlier degrees. I recall very clearly that the percentage of revenue from net interest margin with Aussie banks is substantially higher in comparison to banks overseas. There's so much more diversity in banks overseas. So that's one, probably a business move that could have been better. But then the second thing is, look, they might be thinking of ways to not have to pass that down. And lastly, I also think that they really try to win the channel game. And by channel game is internal lending versus external. And they had a few years where the likes of CBA, for example, did quite well with managing internal lending, really picking up a good proportion of it versus brokers. But then it's clear we've seen such a big industry shift now that mortgage brokers really are the leaders in Australian finance to providing finance for people to buy a home or invest further versus the numbers it used to be. So I think that huge change has now caught them to basically go, oh, what do we do here? But in summary, what that means is this is better for the prospect and better for the client who's there. If you're looking to build a portfolio, to have investment specialist brokers on your team, because if they're not going to fight for your business, considering the margins they're crying wolf on perhaps, then it's an even better time for you to start diversifying with lenders, working with, example, Eva here to help you start to look at your portfolio holistically. Because not even just the interest rate game, one thing Eva does really well is they have the valuation, the interest rate, the policies, the type of entity you're buying in, SMSF, self-managed super fund, family trust, personal names, all of these factors considered when doing a loan review. And this will allow you to take that portfolio one step further because the borrowing capacities are different from bank to bank. Interest rates are different, as you pointed out, Phil. And the policies that get you that one extra can also be very different if you have the right person on your team.
Yeah, I completely agree. And, consumers have voted with their feet. Now, when you use mortgage brokers, to your point, Arjun, 70+% of all mortgages now written through the mortgage broker channel, which I think a lot of the banks have an uncomfortable relationship with. They like the old days where people had to go into the bank branch and they'd offer them one or two products and that would be it. So in many ways now they're relying on the broker channel for a lot of mortgage flows. Some of the rhetoric coming out at the moment is that the mortgage broker channel is more expensive than the direct channel. I'm trying to get some insights into that. No one can really yet answer the question, why is that the case? However, the point is that don't expect, if you want to scale your portfolio, don't assume that banks will pass on interest rate savings when the RBA starts cutting rates. They might reluctantly drag their feet. They might not do it at all. That's happened in the past. We'll see it again in the future. The banks will probably provide more favorable rates to new to bank customers, which means that you may need to refinance. Eva, are you seeing people preparing for this, or how would you effectively prepare for this cycle?
Exactly what I was going to say. We should do a podcast on how to prepare to refinance and what to do to make sure that's easy for you and you don't have anything in the way to do that. So there's a few things that definitely people can look at. So maybe next time we do that and explore ways to be ready.
I am. Lenders won't pass it on. You're going to have to kick it. Like if you like sitting on hold for hours to try and speak to someone in the retention team in a bank, get ready because you're going to have to do a lot of it. You're going to have to fight. I'm just telegraphing it now. You're going to have to fight to get your interest rate savings if and when the RBA starts cutting the official cash rate.
It'd be easier to refinance. It'd be quicker and easier to just move somewhere, and that's a bit more. Yeah,
I'll be doing the first bit first. That's trying to negotiate with lenders, saying, I can get this rate over here. Why aren't you bringing my rate down? And you'll win some of them, you'll lose some of them. The ones that you lose, I'd be getting ready to refinance because they will be incentivizing, and there'll be a lot of discounts or specials available to certain banks. And banks are quite strange. If they've got heaps of dough, they'll they've got their access to capital is good. They'll sometimes take a bit of a haircut for a little while to originate new mortgages. And that's when you can go and get some sharper rates. I'd be tuning in for that. But if you're not a mortgage broker, you're going to probably not be able to find this out. So again, hence the reason why most Australians are now using mortgage broker. They know, like you get told by the lenders, you get emails every day saying, hey, Eva, we've got this particular special at the moment. It's like going shopping at JB Hi-Fi. There will be specials on things. We've got this special for, under $1 million in Perth and we'll finance this sort of stuff, right?
We get those emails constantly about, what type of business they want to attract. And most people would fit into one. So, yeah.
So get ready for it, Arjun. Do you have a view on interest rates, by the way, while I got you?
Yeah, look, my thinking is that interest rates, I know people are saying higher for longer. I feel they've got to head down at some point towards this end of year. Like, I think that they shouldn't be as high as they are now, and others might disagree. There's a whole bunch of different data, some data that's in control and some data that isn't. And what seems to be impacting a lot of the inflationary readings are data that's not in control, right? When I talk about the shopping trends and the spending trends, they're heading down in many areas. Yes, they're above pre-COVID peaks, but they're heading down from, that huge stimulus that entered the economy and what's going out the other direction. And so I feel like we should be looking towards the tail end of this year that we start looking at decreases. But hey, who knows? I've been wrong before on interest rates. It's not as clear and light as as my location analysis is. But that's my call out there that towards the end of the year, we should be seeing it go the other direction.
Yeah, locational analysis, you've probably got a lot more control over, even with interest rates. And to your point, all economic forecasters largely get interest rates wrong. Even the RBA has got interest rates wrong when the former Governor Lowe said there won't be any interest rate increases until 2024, right? Like they get it wrong. Now, the challenge you have, and you're a data guy, Arjun, and for those of you who haven't tuned into Arjun's podcast, Property Nerds, if you're a data freak like myself, you'll get a lot of value out of it. That here we are I'll close the loop on budget day. The budget's going to be handed down this evening. We're recording this around lunchtime of budget day. The government will have you believe that we're moving quickly towards the target band of 2 to 3% inflation. And the budget that they hand down tonight will not fuel further inflation. So they're saying that we'll be within the band a lot faster than what the RBA is telling us. So they've got two very different interpretations at the moment on when we're going to move to that target band. The RBA thinks it's going to be up over 3 for a considerable period of time, whereas the government, from what I understand, is saying it should get within that band within this calendar year. So it's a huge disconnect. You probably saw the RBA minutes from the meeting earlier this month. They're still leaving the door open potentially for rate hikes to tame inflation, whereas the government is telling us today, when it hands down its budget, that we're on a steady road towards hitting the target band of 2 to 3% inflation. And while the government is going to be delivering a surplus in the budget, today, the mail is, Arjun, that it's going to be red for the years ahead as tax receipts sort of start to sort of drop a little bit with, a softening job market and all this sort of stuff. So you don't know who to listen to, do you, mate? Like, how do you make decisions in property when the RBA and the government are selling us different things around inflation?
Yeah, I think that's a definite disconnect there between two big parties. But the main thing is that the good news about property buying is that part there, if we break it down to what it truly is, it's a monthly repayment number, right? If we move all the noise aside, it's a monthly repayment number. And if Eva's doing the checks on your finances and the team is doing it, Finni, the checks at finances, and you're looking at it and going, you can afford X, well, all of this stuff goes out the window, and it's about buying the best property for your portfolio. And so this is where, just during these increases, we've had people see double-digit percentage gains. And historical interest rate increases have actually done the opposite of what most people think. They've actually seen property prices rise because they're usually coming as alongside a hot economy. And a hot economy equals prosperity. So whatever you think an economy means something, flip it the opposite and you're right. And so that's the best way to understand economics data there, that if we're looking at decreasing interest rates, don't just think of it from one angle, yay, mortgage costs come down. Also think of it, it's usually a sign that the economy isn't as crash hot. So there are two sides to that coin, and we've got to be careful what we wish for. Stamping out inflation can be one thing, but at what cost to the economy? Do you go too far up? And then decreasing quickly can be one thing, but is that because you think that the economy is in need of life support? So there's always going to be two sides of this coin. The main thing is it's a repayment. You focus on a repayment.
What Arjun is saying there, when you focus on what you can control and don't get too absorbed or obsessed with what's happening elsewhere. Now, guys, we've got to sign off. This conversation just reminds me, gang, that property investment is absolutely a team sport. You can see how a mortgage broker and a buyer's agent work together collectively and in a combined fashion to support the property investor. So one of the people missing from this equation is an accountant. And, if you've got a good accountant, good mortgage broker, good buyer's agent, it is a team sport. You need to direct them as the coach and tell them what to do and how to do it, but they should be out there helping you make the right decisions. Arjun, Eva, thanks for your time today. Always good catching up. Let's do that podcast for sure on preparing to refinance, Eva, and we'll get Arjun back onto the show and pick his brain a little bit more around how finance can be a huge enabler for supporting you with your investment decisions and arming you and your buyer's agent with the certainty to go out there and find the right properties for you. And Arjun, no doubt you'll tell us that you can do your job better if you know that the client has finance pre-approved.
100%.
Nice one. That's Arjun Paliwal. He's from InvestorKit, founder. You can go and find those guys. Just Google InvestorKit, and Finni, just Google Finni Mortgages. You'll track them down as well. Either of them, no doubt, will be more than happy just to have a chat with you about what you're doing. And even if you just want to pick their brains and stress test what you're doing, or if you want anything further from them, I highly recommend you get in touch. Thanks for tuning in. smartpropertyinvestment.com.au. Smart Property HQ is where you'll find us, or Smart Property Investment on all the social medias. Something's coming pretty soon as well, which I'll let you all know about, which is pretty cool. Watch this space. I'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Feeling trapped by rising interest payments? Escape from mortgage prison with expert refinancing assistance from Finni. We have helped hundreds of borrowers break free from higher loan repayments by finding a more suitable loan. Our expert team can quickly assess your situation, and if there's a better lender available, we'll find it fast. Don't delay. Call today. Speak to a Finni mortgage specialist on 02 8866 2444 or visit our website at www.finni.com.au.